Okay, I sent you guys an email about when the review session is, right? The first one. And if you didn't get it, or for whatever reason, they're all out on Moodle, and I'll be sending them through Moodle, so you can go back and find them. It's pretty easy. News forum there. Anyway, we're scheduled today from 2 to 4 in this room. They'll all be in this room. And then the next one will be Wednesday the 10th. 4 to 6 in this room. So we'll toggle back and forth between 2 and 4 and 4 to 6, about half of them each way, to try to accommodate people's schedules a little better, at least be a half of them maybe. And what we'll do is we will try and record those review sessions, and if you can't make it, you can sit through it and listen to it, right? And watch it work problems and that sort of thing. So fast forward through them. Or you can watch them later if you're testing. Okay? So I had people this summer, I used this smartboard this summer and recorded it on YouTube videos. And they're extremely boring and put you right to sleep. It's even worse in class. Although I don't know, in my intermediate class, I figured out this one, the sound didn't work one time. Yeah, and they liked it. You were a lot clearer when you weren't talking and confusing us, trying to work the problem. So, yeah, maybe turn the sound down now. I hope not. Anyway, so they'll be out there, so that'll make it, I think it'll be useful, make it a little easier. So you can always check on all of that stuff. Oh, I'll let you know when the rest of the review sessions are as soon as I hear back from the folks that schedule the rooms. But it's going to be in here, and they were just making sure there were no conflicts. And if there are conflicts, we'll probably just move next door anyway, so it's not going to be a problem. And then the other thing I wanted to talk to you about, so that was one. I guess we can get out of that. And the other thing I wanted to talk to you about is, some of you went yesterday, there was a pretty good turnout, for the Accounting Association, for the organizational meeting. I wanted to remind you that tomorrow, Deloitte will be here, one of the big four firms during free period in room 234. And then next Tuesday, PricewaterhouseCoopers, another big four firm is going to be here. And then September 3rd, they're going to, Harding Comanche is having an open house at their office 3 to 5 p.m., which is next Wednesday, I guess, isn't it? And then Mountjoy Chilton Medley, which is the largest local CPA firm, small regional, they have a couple offices, they're very large local here in town. It's the biggest firm in town, larger office than the big four firms in town. It's a very large firm for a local. Mountjoy Chilton Medley is on September 4th, which is Thursday, I guess. So this is just nuts, you guys. And then the next week they start again. If you have any interest whatsoever in getting a job, then I believe in you. Okay? It'll just dominate your time for a while. So certainly if you're in the accounting major, you're crazy not to do it. Because you're giving away jobs to competitors. If they don't know who you are, they won't hire you. That's the way it's going to be, Chuck. Room 234. Everything is in FC, School of Communications 234, right above the dining hall, up there in the corner. That room with all the glass on the end of the building. And it's not working. Anyway, we'll pack them in. They'll be standing room only, probably. Yeah, so, anyway, most schools, these firms don't like them. They come and recruit a few people, maybe, but they have firms, their students come to their offices and recruit. They don't come over and over and over and over. Really want to hire. Oh, by the way, we just got notice from Ernst and Young. They're going to try to hire 12 interns full-time and 14 full-time staff this year. That's nuts. And it's double normal. And they would like economics majors and finance majors to come to their evening event, which is probably going to be in here, and they are going to have yoga food or something and do a whole bunch of leadership exercises and meet everybody and go outside and do a scavenger hunt. I mean, it's just a big deal. They spend a lot of money on this, you guys. They spend a lot of money per person to hire the person they want, because those people are going to be really valuable. And I know, if you're a freshman, you think, I'm going to be really valuable. Yes, I can tell you that. You snot-nosed little kids are going to be extremely valuable 2 years from now. Because you won't be little kids anymore. We'll have turned you into formal adults. Who can make money. Done. That's why they do money. So your goal, you guys, meet them. They want to meet the freshmen. They already know the sophomores are coming. I'm not kidding. They already know the juniors. They already hired the juniors. The seniors are all that they don't want. kidding, right? So he's somebody who they want. Oh, by the way, if you're a certificate student, renew, whatever, right, you start doing this, that's okay. You just don't, I just changed my major to accounting, or just joined certificate and you're in. You need to be in this year, right? You're competing with something freshmen who are going to take jobs away from you, okay? Okay, that works. So be there. Don't wait, don't wait, don't wait. It's really awful to do that. Okay, so I guess we have a quiz. Should actually cover a little bit of material sometime. Okay, what's the accounting equation? What goes in the balance sheet, guys? Assets equal plus equity. What's your assets? All your possessions, all your stuff, everything you have control over. It's really probable future economic benefit obtained or controlled by an entity as a result of past transactions. That's what you're going to do today in a meeting. I'm going to write that down for me. It's like that. Okay, on the CPA exam too, but that's what it is. Probable. If it has to be certain, then nothing to be found. The money in your pocket might be counterfeit. It's not certain. So it's probable. Future, if you already used it up, it's an expense. If you haven't used it up yet, you're going to use it in the future. What is it? It's an asset. Probable future economic benefit, cash flow maybe. But what if I have a truck? I'm going to use it. I'm not going to get cash flow out of it. You got the idea? Okay? So what things I'm going to use up in the future? If I have prepaid rent, I'm going to use that rent in the future. I'm not going to get cash flow. Okay? So it's not probable future cash. It's probable future economic benefit. And it's got to be as a result of past transactions. If you haven't bought the asset yet, you don't have the asset yet. Right? Does that make sense? Okay, that's the deal. Okay? So if it's a future thing you're going to do, right, then no, it's got to be a past transaction. Okay, anyway, so that's assets. What's liabilities? Everything you owe. We're going to keep track of all your assets. We're going to keep track of all your liabilities. Everything you owe to everybody, right? That's it. We're just going to add it all up. That's going to be the liabilities. What's your equity? Representation of your wealth. Difference between your assets and liabilities. Have I said this before? Yeah, I say everything over and over and over. And then we're done with this semester. Because it's a simple little model. Just getting your head around it and being able to use it. No kidding. This is not hard once you see the model. Okay, equity, two types of equity we've got. What are they, guys? Contributed capital and retained earnings. Excellent. Okay, so the net income is going to come into the retained earnings. This little T account represents the general ledger account you read about, where you keep track of the debits and credits. It's really a computer record. The computer keeps track of positive and negative charges. They don't care about left and right. But we still make it look left and right so that we can understand. Okay? So, yeah, we still call them debits and credits. Okay, anyway, and then we have these temporary equity accounts. What are they? Right? Oh, by the way, contributed capital is what the owners contributed, right, guys? And retained earnings is the earnings we retain. Geez, yeah, this is not hard. Okay? How do you know? Well, it's what it says. It's what it is. Okay, so what goes in the income statement? These other two, they're a subset of equity. What are those? Revenues, excellent. And expenses, that's right. And the difference will not be an account or types of accounts. What is it? Net income if revenues exceed expenses, right, guys? Or it could be what? Net loss if what? Well, if the expenses are more than the revenues. We don't say negative and positive, really. I know it's kind of negative to have a loss. It's kind of positive to have a gain, but in income, but we kind of stay away from that at first, at least. What are we working with instead of plus and minus? Left and right, left and right, left and right. What are we working with instead of good and bad? Left and right, left and right. What do we call left? Debit. What do we call right? Credit. God, you guys have to make it. Right? You have competitors taking 101 this semester who will not know that. And they are going to let you have a really good grade for knowing left and right. Isn't that nice of them? Kind of cool, huh? You should thank them. You should send a thank you note. Thank you for flunking the class and keeping the GPA down so we're a good school. Just so you didn't want to left and right. So you have this ingrained in your soul, right? You know what debit means. You know what credit means. And that's how we think. So it wasn't wrong to say it's a negative, but stay with it. Does that make any sense? It'll confuse you. Is my point. Well, and I confuse you enough. All right, you guys, let's take debits and credits then. What's a synonym for debit? What's a synonym for right? Oh, we're good. Okay, you guys are there. Very good. All right, and repetition does pay off. It really does. You keep working problems until you really have it wired, and you'll be just fine. Okay, let's take the debits and credits and put them in here. Assets are on which side? So how do you increase them? That's how we get a normal balance of debit in it, right? By increasing with debits. How do we reduce it then? Seeing as we don't add and subtract stuff anymore, we just take the difference between debits and credits. How do you reduce them? Excellent. Okay, liabilities and equity. All types of liabilities, all types of equities, right? Are increased with what? Because they're on the right, they're increased with what, guys? How are they reduced? Excellent. You're good. All right, now think about this. Slow down for just a second here. Revenues and expenses are a subset of equity. What we do is we keep track of our increase in wealth by selling things. That's our revenues, right? Our revenues is the representation of all of our sales and goods and services, okay? If it's services, we call it service revenue. If it's goods we're selling, product we're selling, we call it sales revenue. Everybody got it? So it's a different terminology a little bit, okay? We keep track of all the different ways that we earn revenues, okay? And what does earning revenues do to our wealth? It increases it, of course. Okay, so if revenues are a subset of equity, how do you increase equity? Retained earnings being a type of equity. How do you increase it? With a credit, right? We're going to increase retained earnings with a credit, aren't we? Notice that's on the right-hand side. Debits on the left, credits on the right. Everybody good? Debits on the left, credits on the right. Everybody got it? That T account, we're going to do the same thing. We're really clever as accountants. We put everything on the left that's a debit, everything on the right that's a credit. When you do journal entries for me, which is just listing the transaction, listing your debits and your credits, put the description to the left, if it's a debit, and put the number to the left too. Okay? If it's a credit, put the description to the right and the number to the right also, and no one will ever be confused about what you're doing. And then you don't have to write debit or credit down next to it. Why don't you have to write that down next to it? Obvious what it is. That's how we do it. Okay? You also don't have to write down next to the account whether it's an asset, a liability, an equity, or a revenue or expense, because we all know what those things are. I know when you look at the way the author's doing it, they're doing that. They think they're helping you learn it. I think they're driving you crazy. Right? So don't do that when you're doing a quiz for me. Just write down the entry, okay? And I'll show you how to do some today. Right? Make sure, what happens if you put everything in a row? You put all the descriptions in a row, and you put all the numbers in a row, and all of them are the right numbers and the right descriptions. I will give you half the points. I'll assume they're either all debits or all credits, and you know, if you got half of them wrong. Everybody got it? Don't do that. Okay? I can't tell what they are. And don't write debit and credit down next to it either. It'll drive me nuts. Right? And put them all in a row. Don't do that. Okay? All right. It's not how it's done. All right? So just convention, kind of. All right. So revenues, we said, are increasing our wealth. We increase our wealth with a credit, we said here, right, guys? So guess how you increase revenues. If you increase wealth with a credit, how do you increase revenues? Temporary equity accounts. What do you do? Yeah. And what we're going to do is we're going to keep track of it for a year, and then we're going to do what's called closing it. We'll get that in chapter 3. We're going to close the revenues and the expenses into retained earnings and start over, adding up another year. Because everybody'd like to know how much money you made this year, and then next year, and then the next year, and then the next year. So these are temporary accounts. We also call them nominal accounts. They're temporary equity accounts. Okay? All the balance sheet accounts are permanent. Because you know what? We don't close those accounts. Does your cash go away when you start a new year? That'd be awful. Although I'd like it if my liabilities went away if I started a new year, wouldn't you? Too bad, I borrowed $100,000 from you the last day of the year, I don't have the money to pay you back, so now I don't owe you anymore. Doesn't go away, does it? And luckily, so our assets don't go away, our liabilities don't go away, and then of course our wealth doesn't go away if you start a new year, right? And the revenue expenses don't really go away. What happens? We just add the net income to retained earnings. So what comes into retained earnings here is going to be the net income, guys. We just put it in there. Okay? That's what's going to go on. Okay? It's just not a big deal. Okay? So revenues will be increased with credits. What if you put too much in one? What do you want to do to it? Debit it to fix it. We don't cross off the number and write it differently. It's in a computer reading. Okay? We never did even when we did that. Okay? Just make another entry for it. Right? So you can always debit a revenue account reducing. Okay? Expense accounts have to be the opposite, don't they? Because we don't remember what to add and subtract anymore. We're just going to take the difference between debits and credits. So if revenues are credits, guess what expenses have to be? Debits. So you can remember it that way, or think about it that way, figure it out that way. It's a better way to put it. Okay? But what's the logical reason for this? What do expenses do to your net income? They decrease it. What would they do if you're in a loss position? Increase your loss, right? In either event, what's going to happen? As I have more expenses, I have what in terms of wealth? Less. I'm reducing wealth. Now get your head around this one. This one's tougher. Okay, the way that I would show a reduction of wealth over here is with a debit, wouldn't I, right? In equity accounts in general, right? Debits reduce them. So as I am increasing expenses with a debit, I am reducing equity. That makes sense? That's all we're doing, okay? Still left, right. Okay, so if I use debits to increase expenses, guess how I'd reduce it if I put too much in it? Credit, we got it. Okay, now, net income and net loss is not an account, it's just the difference between revenues and expenses, right? Everybody's got that clear. The author said this pretty clearly, didn't he? But when you read it, it's kind of like, oh, right? Now I've pounded on it like 3 times now, right? Kind of? I'm maybe 2, we're doing 1 now. Okay? And it's starting to sink in, isn't it? Can you do that for yourself instead of me doing it? That's what I want you to be, by the way, you guys. When you're seniors in this place, I want you to really not need us at all. I don't do review sessions with 100 level students. You know why? No one comes. It's more productive for them to study some more on their own. They come to class just to see if I happen to say something they don't already know. That's where we want you to be 3 years from now, okay? We want you to be there in all of your classes. So that's part of the process here. Right now, you guys probably need to be here, at least you think you do. You'll show up for the review sessions and you'll work with me. I want you to get so you can do it on your own, okay? Wouldn't it be cool if you just read a chapter and already knew how to do it and you didn't have to study? Oh, wow, what a neat concept. Now, I never read anything twice, unless it's really complex. I could read something else. Right, guys? I don't watch movies over and over either, at least not on purpose. Sometimes I watch movies I've seen before because I can't remember what I saw. But yeah.
Speaking of the review session, is it going to be in here or somewhere?
It's going to be in here. They're all going to be in here. Yeah. Okay. All of them will be in here. But some at 4 and some at 2. This one's at 2. Right? So come for whatever portion you can come, by the way. All right, guys. Net income, a debit or a credit? Seeing as the revenues would exceed the expenses, it makes it a credit, huh? And what we'll do is we'll take that credit and we'll add it to retained earnings before we start the new year. That's what we're doing. What would net loss be? That means the expenses exceed the revenues, right, guys? Net loss would be a debit. And what happens is when you close, we say, but when you take the net income and put it into retained earnings, this time it's a net loss, so the net loss would come out of here, okay? And the only other thing that really happens with the retained earnings is you don't have to retain them. What if you don't retain the retained earnings? What does that mean? You pay them out to the owners in the form of a what? Dividend. You got it, okay? So what do you think a dividend is going to do to equity? What's the dividend going to do to the wealth of the company? I don't mean the wealth of the owners. The wealth of the owners doesn't change. They have the wealth in the business, and then they take the wealth out in the form of the dividend, right? So they have more because they got the dividend, right? But what happened to business? It went down, didn't it? By virtue of the dividend. So we're doing the accounting here for the business, right? So if I pay a cash dividend, I will credit cash, reducing the asset, and I will debit what? You can use the dividends account if you want, but really it's a temporary retained earnings account. Retained earnings. Yeah, I'm going to reduce, and I'll close it retained earnings. I'll put it in retained earnings. I am reducing retained earnings because I took some of it out, right? Is that an expense? No. Let me ask you this. If I invest $100 in an account that earns me 5% a year, what will I have in the account at the end of the year? $105, right? 5%. How much would you say you earned? $5. What if you take 5 out and there's only 100 in the account? Would you say you earned nothing? Of course not. What would you say? I earned 5 and I took 5 out, right? So the net income is what you're earning. The dividend is what you took out. You can take out the earnings or not, right, guys? We call it reinvested if you leave it in, right? Okay. Now there's some questions. Oh, first let me write this down. I'm thinking about it so I don't forget. Where do you put the dividends, guys? The dividends are a debit, right? Why are dividends a debit? Reduces the retained earnings. You didn't retain it. How do you increase retained earnings? Seeing it's an equity account. Is that right? Increase with what? Credit. So net income would increase. How would you reduce retained earnings? Debit, of course. So what if it's a net loss and it's reducing retained earnings? Debit, right? Debit retained earnings. What if it's a dividend and you're reducing retained earnings? Debit it. You can change anything now. You guys are going to be full charge bookkeepers before we're done with this week. Yeah, you don't want that. Okay, we had questions several places. We'll talk about it. Yeah.
Okay, if you reinvest the dividends, where is it? What?
You don't do anything. You have assets because you earned, right? Oh yeah, because you just don't pay it out. You don't need it to. We'll get there. And there's no transaction if you didn't do anything. You just kept it. So as the company earns revenues, they have more assets or less liabilities. It's true. If they incur expenses, they either have more liabilities or less assets. And we'll do that right now. Okay? That's a great question. Another one over here?
So if the company declares dividends, that's not the same as paying, right?
No, that would be I debit retainers and credit dividend payable. I owe them the liability, and then when I pay it, I debit dividends payable and credit cash. That's later chapter. That's what would happen.
But it's not the same.
Not, the declaration is not the same thing as payment. No. That, you usually, a big company would declare it, and then some time would go by and they figure out who owns the shares on a particular day, called the date of record, and then later they pay it. And they got a million shareholders, I can't declare it and pay it the same day.
Okay.
That's all, okay? But
They're just saying, hey, we made a profit.
for now, we'll pretend we're a small company, and when we declare the dividend, we also pay. So we'll debit retainers and credit back for now. Okay, got it? Yes, sir.
We're gonna have a business. I have heard some customers of his ask for credits when there were times that he couldn't get to clean their pools, and they pretty much had to work do their pools for free for that week or so. Is that?
Oh, they're asking for credit?
They're asking for credit. Is that?
Yeah, that's a credit against their account. And so what we're saying is, he has an account receivable from them, and he reduces receivable. That's all we're saying, and we'll get to that too. Okay, yeah, they put a credit on their account. So they get something for free. Yeah, we'll learn how to handle that. It's also it's like a sales return allowance, the ability to allowance. Because he wasn't able to do something, and he promised to get him the benefit. Other ones?
So we do that with the balance sheet. That would be.
No, it's part of the contributing capital is a type of equity account, like preferred stock, common stock, retained earnings is also an equity account, type of equity, right? And this T account, these T accounts represent general ledger accounts. So what I meant to imply, and I wrote over it right over the top of it, I apologize. Retained earnings would look like this, right? Beginning retained earnings hopefully is a credit, although it doesn't have to be. You could have a retained deficit if you lost enough money. So this represents the debit side of the account. This represents the credit side of the account. So whatever I start with plus my net income, right, or less my net loss, you only have one or the other in a particular year, and less any dividends if you paid it, would be ending. So this T account just represents a general ledger account. And we can represent an asset account, liability account, equity account, revenue or expense account with it. Did that do it? Yeah. Okay, good. You guys have great questions, and you're really a strong class of really good. This is really nice. If you're not staying with me, I want your hand in the air because I'm going way too fast for pencils. Even more than I usually do, but you guys are really good. I can just tell it from the get-go here. So you do the first quiz and flunk it. But yeah, anyway, so then I still won't slow down. So then I'll yell at the finish later. Did you have a question on that? Or you asked it? Somebody else had a hand up there, didn't they? Okay, cool. All right, guys. Let's take this then and let's do a bunch of entries. Okay? So let's do this. I want you to pretend. Oh, by the way, this was 3 points in that quiz that summer, wasn't it? Summer before last. You see, this is the first question. I want all that. What you see on the screen there? If you can do all of that, you got to make it. You're welcome. I'll give you a few points for this. Okay? Probably even be on the final again. Maybe be on the test. I don't know. All right, what I want to do is real quickly, so we have it, and I want you to put that on a piece of paper if you haven't already, or a note card or something that you use when you're doing your homework. Pretty soon you'll throw it away because you won't need it, right? A little study aid. So I'm not big into study aids, but that one works good, I think. All right, so what are the accounts again, the 5 types of accounts?
Assets.
And equity, right? Okay, and then less expenses. It's going to be my net income, right, guys? Okay. So how do you increase assets? Debit means left, credit means right. Everybody knows that, right? Debit, left, credit, right. And you make sure the two sides equal each other so you're in balance, right, guys? Okay. How do you increase assets? Debit. How do you reduce them? How do you increase both liabilities and equity? How do you reduce both of them? Okay, always. And how many different assets might there be? Billions. If you know something's an asset and you have more of it, what are you going to do to it? Debit it. If you get rid of an asset, what are you going to do to it? Credit it. This is easy. Everything's easy now. If liabilities, if you incur a debt, I have more debt, what do I want to do? Credit it. Credit the debt, right? That's how you increase debt, liabilities. How would you reduce it? Debit, every time. Equity, how would we increase it? Credit, that's why we're increasing retained earnings with net income. Everybody got it? You credit those accounts, all of them. Any equity accounts, you credit them to increase them, okay? There aren't very many left, so a handful of those. All right, and then if you want to reduce one, yeah, like the dividends and net loss over there in retained earnings, that was reducing it, wasn't it? We got it made. Okay, revenues and expenses are a subset of equity, like we said, so how will you increase revenue seeing as they increase equity? With a credit. If you put too much in, what do you do? Reduce it with a debit. We're good. Okay, expenses, they have to be the opposite, and they reduce wealth, don't they? Reduce equity. Okay, so expenses are temporary equity accounts. How would you reduce equity? With a debit. So as I increase those with debits, what's happening, guys? I'm reducing my wealth, my equity. Got it? And if I want to, I apologize if there's not more blackboard space. This whiteboard is supposed to be over there. Right? They stuck it behind the screen. I know you guys on the other side can't see what I'm writing, but oh well. All right, anyway, it's just what we had on the screen anyway before. But I want you to have this right in front of you all the time. Expenses then increase with a debit, reduce with a what? Very good. All right, and net income would be a credit. Net loss would be a debit. We're good. Okay? And then if we have retained earnings, we think about retained earnings, well, it's right over there. Right? Positive net income is going to increase retained earnings with a credit, right? Negative net income, a loss. We don't call it negative net income. We call it loss, right? Reduces retained earnings, and dividends, of course, you're taking retained earnings out of the company. Everybody sees this model. That's the whole model. I'm not kidding. And then we just take understanding business and apply it. Boom, 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 boom. You make a couple $100 an hour doing that. It's ridiculous. What a scam this is. Don't tell people how easy this is. Right? You don't want them to know. You know, oh no, accounting's really hard. It pays a lot of money. Come on, you know. It's like doctors. I have some executive MBA students who were surgeons over the years. And I'm like, it's not like rocket science. It's like changing the oil. You know, doing open heart surgery. Big deal. Once you got to do it, you just do it. And yeah, you cut people open, you hold their heart in your hand. Well, yeah, I can have some parts and put them in. That's right. Once you know how to do something, if you're a good person, once you know how to do it, you think that's not a big deal. It's called being humble, right? Big deal. I don't want to hold anybody's heart in my hand. One of them do it. Two, I might kill them. Right? Yeah, that'd be awful. So this way, I screw up your life you want to do, but at least I didn't kill it. Right? All right, guys, let's do some transactions. Let's just start doing some, okay? Let's say we start a business, okay? Let's start a business, and the owners invest $100,000 cash in the business in exchange for contributed capital named common stock. Common stock is a contributed capital account. So what does the business get? Oh, 100. I think I said it. Okay, 100,000 of which is a debit because it is an asset. You got it. And what we would do is we would go debit cash. Thought I could read that small. You know, debit cash. Yeah, what for? It's a waste of time. I don't want heavy. I want debit cash. Okay, I want cash to the left because it's the debit. Okay, you don't need. You can label your columns debits and credits if you want. Debit column and credit column. I don't care. I know, it's so meticulous. And you know what? The computer's going to make it look like debits and credits and put it to the left and the right and make it look real pretty. You just make sure I can tell you meant debit or I can tell you meant credit. And we'll be good. All right. Now, you know what? The debits have to equal the credits. What do you want to credit, you guys? Common stock. And what kind of an account is common stock? It's a contributed capital, which is an equity account, right? Which then is a credit because I'm doing what to common stock, seeing as I issued some. I'm increasing it. How do you increase equity? With a credit. I'm not kidding. That's it. Okay? All right, let's take $20,000 of the cash and let's buy a truck. Pickup truck, old one, I guess. What do you want to do, you guys? What did I get? I got a truck, which is a asset, and I have more of an asset. How do you increase all the assets? Debits. Why? Because they're on the left. See, things are going to get complex, but the model doesn't. It's really wonderful. It's so comforting. You can go back to this model and say, well, where am I? If you can't make the journal entry, you probably don't know whether you got an asset, or you got a liability, or you got equity, or you got revenue, or you got expense, or you gave one of those up. That's all there is. And by the way, you can exchange assets for assets. You can exchange assets for liabilities, right? You can exchange revenue for an asset. You can exchange expenses for liabilities. You can exchange expenses for assets. There's all kinds of different transactions. But these little rules are always going to work for us, okay? So just relax and use them, okay? So the hard thing is figuring out what happened. That's all we talk about. Recording it, doing the accounting is nothing. It's just not a big deal. Okay, so what did I say, 20,000? We got a truck. It's an asset. What do you want to do, everybody? Debit it. Now you got 120,000 of assets? Is that right? Nah, you don't. Because what did we just do? We bought it with, what did I say it was bought with? Cash. So we would credit cash. Why am I crediting cash? Because I want my debits to equal my credit. But really, why am I crediting cash? No. I debited the truck because I got the truck. What did I do to cash? I gave it to wherever I got the truck from. I don't have it anymore. So what do, you guys? If you have less of an asset, what do? You reduce it with a credit. That's it. Okay? Now let's do a T account for cash, and let's look at this. The account cash. I just started the business, right? So, by the way, when you start a business, what's the balance in every single account? 0. Remember that. If I give you a problem that says, like I will, because we're just getting started here, this is their first year of operations. What's the balance in every single account? Cash, receivables, inventory, payables of different kinds, all the assets, liabilities, equity, revenue, expense. What's the balance in every single one of them when you start? You've done nothing. 0. And then you build that balance sheet and that income statement. We create it by doing the accounting. Got it? And of course, when you start the next year, you still have all your assets, liabilities, and equity left over from the end of the prior year. Did you guys know that at December 31st exactly, there is no time between December 31st at the end of the year and January 1st of next year? It's instantaneous. You ever see those stupid shows, for New Year's Eve when they have the balls go up or down, whichever direction they go, right? Ever seen that? It's really instantaneous, right? They count it out. Yeah, remember that. Ending balance of one year, I bet you anything is the beginning balance of the next year. You suppose so? Huh? Okay. That's, yeah, but remember that. People kind of forget it. Oh my, nothing can happen in between years. There's no time in between years. By the way, the year doesn't have to end December 31st, by the way. We can use a fiscal year. It can be any day you want. Okay? Come to you. September 30th year and June 30th year, whatever, it doesn't matter. You just count 12 months from there. Okay, all right. So what we did was we put 100,000 cash in here. Everybody see that? That 100 came in here. This is called posting, by the way. Copying it into the general ledger account is posting. General ledger account is places where we keep all of our accounts. The accounts are all the assets, liabilities, equities, revenues, and expense. Okay? We keep track of debits and credits on all of them now. Computers are wonderful at this. But then we got 20 coming out of here. So how much cash would you have left? Now just think about this. If you start with nothing, and you put 100,000 cash in a bank account, and then you take out 20, how much will you have in it? 80. Wonderful little system, isn't it? So that's 80, not 800. Okay, so we constantly keep track of how much we have of everything. That's what we're doing. Got it? And then we put it down on financial statements, just copy the balance. What the balance would be there is the 80, and I copy that in the balance sheet, right? That balance in the account in the balance sheet, and that's how I get my financial statements. I write the revenues down on the income statement, the expenses down on the income statement. That's how I'm going to get financial statements, just copying the numbers. So you can computerize this really easy. What's hard is understanding the transaction. What was exchanged is the transaction. We're transacting business, we're exchanging. That's what's hard. Everybody good? Right? Doing the debits and credits is not. Okay, let's buy a building. And let's buy the building for $200,000, and let's put down 20%. Give me that journal entry. Everybody write it down. I bought a building, $200,000. My down payment is 20%. The rest, I sign a mortgage for it. They're going to have its collateral for the debt, the building. Yeah, maybe call it mortgage, no pay over. Yeah. So I guess you know, pay 200,000. I put 20% down. This is a 3-part journal entry. What did I get? What did I give up? I got one thing. I gave up 2 things. Right? Just let yourself think about what's going on here. So when you're doing these problems and they give you a description of what happened, I do not expect you to have memorized what all those transactions are. What do I want you to do? Figure out what they got, figure out what they gave up, and write it down. That's it. Wow, this gets easy. Okay, so guys, what did I just buy? It is a asset, right, more or less. This is the thought process. So debit or credit? Debit, no kidding. You can see why I do this, because it's really simple. Absolutely. What did you get? I bet the down payment's cash. I don't know what you make your down payments in, but most folks do that. It doesn't have to be. You can give them a piece of equipment or something, I guess. But if we give them cash, probably. What's 20% of 200,000? 40,000. We just reduced our cash by another 40, and now we have 40,000 cash left, don't we? Everybody got it? See what's going on here? Oh, that journal entry didn't bounce. I need another what? 160? What's that, you guys? Mortgage notes payable. Or a mortgage payable, either way. And you can abbreviate as long as I can tell what it is, right? Nah, you got it for now. Okay? If I said I signed the mortgage, I'll call that mortgage notes payable. Right? Look good? This is easy. Okay, what happened to our balance sheet with that transaction? What if I asked you, what happened as a result of that transaction? What happened to the balance sheet and the income statement? I ask a lot of questions like that. So I know, because we're creating the financial statement here, right? So what did we do? This journal entry right there, what do we do? Increased assets by 200,000. Everybody agree? And decreased assets by 40. Right? So the net change in assets is increased by 160 and increased liabilities by 160. That's it. That's what happened. Did I stay in balance on my balance sheet? Sure. What happened to equity? Seeing as there is no equity account in here and there is no revenue expense account in there, what did I do to equity? Nothing, of course. Okay? You can't do anything to it unless you make a journal entry to it. Got the idea? Debit or credit. Okay? What did I do to revenue and expense? Of course, if there's no revenue expense there. Nothing. Okay? Yes, sir.
So let's say you give us that question on quiz, that's all you want right there.
Yeah, you got debit and credit. And if I ask you what it did, increase or decrease, what accounts? It's done. That's all there is to it. Later I'll ask you what would happen if I should have made this entry and I shouldn't, and I didn't. I should have made it, but I failed to. Later I'll ask you that, which is just, guess what? My assets would be understated by 160 if I fail to record it, right? And my liabilities would be understated by 160 also if I fail to. So those are going to be the kinds of things I have to see if you really deeply understand how this model works. Okay? Good. And by the way, we've already done the stuff that's on this quiz. You guys have looked at the quiz right here? We've done a lot of it. Right? That one problem with all the unknowns, right? If you have any trouble doing that one, right, which most people do, I like to give it to students without giving an example of it first because it's really fun because nobody gets it right and just pull their hair out. It's really good for you. Right? Okay. But still half of you're going to pull your hair out anyway trying to do it. It won't work. Right? When you do it, you don't quite understand yet. Once you do, it's just, geez, that's a joke. Okay? I'll be doing that in the review session. So if you're not here and you're having any trouble with that, find that portion, right, of the YouTube video and watch me do it. Huh? Okay? And you'll have it. Okay? And then practice. So I want you to be able to think about this stuff really quickly. You're not going to be very valuable out there in business if you have to go study something for 3 days before you can answer a question. or before you can do something. That's not real value. You're too expensive. So what do we want? We don't want you to remember everything. We want you to be able to figure it out really quickly. Really quickly. So thinking, okay? And then you're going to be valuable, guys. And plus you're going to have a lot more fun. And get to go home once in a while, things like that. You get stuff done. All right, let's keep doing some entries then. Seeing as you guys are so good. I haven't yet, but I thought I'd make one up. Do you want to? Let's buy it. What's that? With those, there's no revenue expense yet. Nothing, right? Did you guys see any revenue expense account there? No. So are there any revenue expenses recorded if we didn't credit revenue? Is there a revenue? No. If we didn't debit expense, is there an expense? No, of course not. Oh, if I asked a question, yeah, you'd say no effect. Nothing. Did nothing to it. Yeah. I see what you're saying. Yeah. So this would be nothing on the expense, nothing on the net income, nothing on the revenues, right? Okay. All right. Let's try another transaction. Let's say that I go and buy some product that I'm going to sell to customers, and I buy it for $5,000, and I'm going to pay for it later. So I buy it on open account. Oh man. What do I call product that I buy that I'm going to resell to my customers? I'm Kroger buying milk, buying bread. I call that merchandise inventory. That inventory is a what? A possession I have that I am going to use to generate revenues in the future. I'm going to sell it to my customer. What is that inventory to me? It's an asset. Okay, we're going to call it merchandise inventory or just inventory. So I'm going to take inventory and do what? Debit it for the $5,000. Why am I debiting it? Because it is a what? Asset, and I have more. And how do you increase all the assets every single time? Debits. As soon as you realize I bought an asset, I'm there. If I paid cash, I'd credit cash, right? Because I'd have less of that asset. But I said, no. I'm buying on account. It's far more likely. Business to business, when businesses are doing business with other businesses, they have accounts payable. Well, I gave it away. They buy on credit, right? They're going to pay them later. Okay? You don't stand at people at Kroger don't stand in a loading dock with $100,000 cash in their pocket, right? Or in a bag and hand it to the truck driver when they deliver the product. Right? They bill them and they send them a check, or they actually really wire them. Right? Yeah. It's all electronic. We don't hand truck drivers $100,000 cash. We never had the guy in a loading dock with $100,000 cash, right? We don't really do that. Okay, so it wouldn't be cash. What would it be? I'm going to pay them later. So I what? I owe them the money, and that would be a what? A credit to a liability. It's a liability, and do I have more or less liability? More, and how do you increase liabilities all with a credit? See why you want to get this model down? So you don't have to be thinking about that. Yeah, it's a liability. I have more. Oh, yeah, it's credit. Okay? What's the name of the liability? It's on open account, which means I didn't sign a note. That's all it means, right? They're trusting. They do. Okay? It's an open invoice or an open account. So what do? You credit an account named cleverly. Accounts that are payable is named accounts payable. It's just amazing how we name things. Okay? Because that's what it is. All right. Now what I want to do, okay, is I want to sell some of that. So let's say that I sell $2,000 of it. Okay? So I'm taking $2,000 of that inventory. You got it? That's the cost of it. But my sales price is $3,500. So I'm going to be making, that makes sense, guys? I bought it for $2,000, I'm going to sell it for $3,500. I'm going to be making a gross profit of $1,500 on that. Would you agree? Yeah, you buy something for $2,000, you sell it for $3,500. You made $1,500 before all your operating expenses. We have a lot of other expenses. I got my employees, I got my truck drivers, I guess it's employees. I've got my rent, and now I've got utility expense. Everybody got the idea? Okay, but this is going to be our first revenue and our first expense, and I'm giving you a hard one right up front because you're such intelligent people. And besides, I think it's just confusing to be slow about this. It just doesn't work. Here we go. Let's sell this. There's going to be 2 entries. Oh, let's make it worse. Let's sell it on account. I'm going to trust my customer to pay me. What do I want to record? An account receivable. They owe me how much? $3,500. What else do I want to record of that 3,500? What's that? That's my what? Sales revenue. Yeah, that's my revenue, right? That's what I sold it for. Excellent, guys. That's fantastic. So what I'll do, how do you increase revenue accounts? All of them? No, revenue accounts. You got a 50-50 shot. Come on. Revenue account. It's either debit or credit. What is it? Revenue accounts are what? Temporary equity accounts. Equity is on the right. It is increased with a credit. How do you increase revenues, therefore? With a credit. So we're going to credit sales revenue. Work on it until that just becomes automatic to you. Okay? I had a student in my evaluators the last time said that I mean students when they get things wrong. Oh my gosh, I think I'd be kind of nice. I'm just teasing, right, guys?
We do it wrong in the real
We're all
world.
stupid. It's not a problem. What's that?
If we get it wrong in the real world, we get audited in jail time.
Well, yeah, maybe. Yeah. Nah.
So you're being
That's,
incredible.
yeah, there we go. Yeah, I'm not throwing you in jail for making a mistake. All right, credit sales revenue 5,000, right, guys? Whoops, 3,500. Did anybody notice I used the wrong number besides me? But you don't want to tell me because you think he's the teacher, he must know everything. Please don't do that. I make all kinds of mistakes. Okay, it was the 3,500, right, guys? Have the courage to say to your boss. I think that's right. Polite. With me, you don't even have to be polite. Just say, come on, Keith, it's not 5, it's 3,500. Okay, anyway. So credit sales revenue, 3,500. And what do you want to debit? What'd she say back there? It's accounts receivable. What a clever name to call things your customer owes you. An account receivable. You like that? Good, isn't it? What kind of account is that? I debit it because it is an asset and I have money. Got it? Okay, and then I also want to record the cost. What's that going to be, you guys? What's that entry going to look like? What did I give the customer? They walked away with what? The product, which I called what? Inventory, merchandise inventory. It was my asset. It's included in that 5,000 inventory, isn't it? I'm taking 2 out of there. If I take 2 out of there, what's left? 3. So I got to get 2 out of that account, don't I? They walked away with the inventory. It's an asset I used to have. I don't have it anymore. What do? Credit inventory. Everybody see what's going on? Right? That's a credit. Yeah, I'm going to put debits and credits in. Yes. Okay? It doesn't matter where we put it. On a real journal, we put them all in a nice, pretty row. Yes. Did you have accounting in high school or something? No, you just look at how careful the author is with everything. Yeah, okay. Right. That's fine. Accountants really aren't boring. We just try to understand it. So I could care less where you write them, as long as you can find them. Right? Yeah. So, all right. It's better if they're all in a row. I can find them easier. Everybody can. All right. So, what would the debit be? I no longer have that asset, and it became a what? What did it become? Well, it's going to hit equity, but what happens to equity? I gave the asset to the customer. They walked away with it. It is the major cost of getting the revenues. Will they give me the $3,500 if I don't give them the $2,000 inventory? No, I have to. So what's the major cost of getting that revenues? That $2,000. It's going to be an expense. Yeah, cost of getting revenues are expenses. That's exactly it. That's the connection, guys. And guess what we call this expense? It's really a clever name. Most expenses have the word like rent expense, salary expense. Put the word expense after the description, and you know it's an expense. Right? Pretty easy. Utilities expense, rent expense, salary expense. Right? You got the idea? Wage expense, interest expense, right? Okay. But this one's different. We don't put the word expense on it because guess what we call it? It is the cost of what we sold, and therefore we call it cost of goods sold, and that's an expense account. Okay? Cost of goods sold. Everybody good? So again, I said the gross profit. Let's extend this page down a ways, right? I said the gross profit on this sale is $1,500. Well, you can see sales revenue is $3,500. Cost of goods sold is $2,000. The difference is gross profit, right? Let's look at what happened to our balance sheet and our income statement with those transactions. Here we go. What did this do? Debit accounts receivable. Assets up 3,500. Everybody agree? What did this do? Revenues up 3,500. You have to know what you did or you couldn't have done the journal entry in the first place. Cost of goods sold, expense up 2.0. Everybody agree? Inventory is an asset, down 2.0. Okay, what's the net effect of all this? Net income is how much? Increased by 1.5. The gross profit on the sale was 1.5, right? 1,500. Everybody agree? What's that going to do to your retained earnings, your equity? Increases. So when you do a balance sheet, you guys, if you're not at the end of the year, if you haven't already closed the books, when you do a balance sheet, you got to take the net income and add it to equity, add it to retained earnings, right? Because we got a bunch of debits and credits over here, thousands of them in the company. Okay? So this would be up by 1.5. Everybody agree? 1,500. Well, what happened to assets? They went up by 3.5 and then down by 2.0. What's the net effect? Up by 1.5. What happened to liability, seeing as there's no liability in those journal entries? Nothing, of course. Does 1.5 equal 1.5 or what? Okay, I want to do 2 more journal entries and I'll let you out of here almost close to on time. Yeah. If you guys would just get here on time, you know, like 10 minutes early, I'm kidding. I know you come from other classes. Get here when you can. All right, so here we go. I want to receive payment from my customer. Give me the journal entry for receiving payment from my customer. Debit what and credit what? What'd you get if you got paid? Cash, which is a, and you have more. What do you want to do to it? This is a weird thing, the way you do this, because then I lose what I needed. Ah, for God's sakes, now what do you do? Okay, anyway, you debit cash how much? How much was it? 3,500 in the receivable? Say they paid it all. They wouldn't have to pay it all. And credit what if they paid you? What account? You don't have the account receivable anymore. What does that do to accounts receivable, by the way? That increased cash, the asset, what does it do to accounts receivable? Decreases it, right? But that's what happens, right? They don't owe it to you anymore, so you reduce the asset with the credit. And then the other one is our payable. What about our payable for 5,000? Let's say we paid for the inventory. What do you pay for it with? Cash. What do you do to cash then? It's an asset, you have less. What do you want to do? Credit it. And what don't we have anymore? I paid off the account payable, which was a liability. Increased liabilities with credits because they're on the right, and how do you reduce them? Debits. We're there, you guys. Can you do this? Of course you can. Now I could throw any assets at you, any liabilities, any equities, any revenues, any expenses, and you could do this. Right? Right? And I know this is way too soon to expect you to do it, but it really works. Because do I have you studying already? And if I waited for the quiz until the day after the holiday, what would you do to me? You'd wait. And you can't, can you? You're welcome. Yeah, you're learning already. You're not in your other classes, are you? You're supposed to. Right.
In the review, will you have writing names for us to practice?
I'm going to use the ones that are online. If you go to Moodle, you can find this. And you're going to want to do that. If you're not making it to review, print yourself out the quiz, right? Pull it up on Moodle, right? Have you been up to Moodle yet and looked at the class? There's old quizzes, quiz 1 and 2. Click on it, it'll open as a Word document, print it, right? And then have it sitting in front of you, and you can work on it. Well, first, try to work it, and then, what can you do? Cool? Thanks for coming, you guys. Your time is valuable. You sticking around for another hour? Cool. I'm back. Oh, yeah, sure.
And you said in the review session starts.
Yeah. What is wrong with this thing? It's like it's locked up. Oh, okay. That killed something. I can't get it to move. Oh, come on. I've confused it. Let's see. Let's try this. Okay, there we go. Now this. You want the inventory part and the right there? Does that do it? Yeah. I guess I could stop recording too. Already boring enough.